So again, the next question would be, how do we put this into a trading plan? So this is an example of a trading plan. So for example, if you identify, hey, this stock has a probability of going up, right? So you enter at today's price, okay? And again, when you enter, you always have a stop loss because you can have losing trades. You can't be right all the time, yeah? So from your entry price to your stop loss, the distance is called 1R. What does R stand for? R represents risk. This is your risk per trade, okay? So again, later I'll show you how to calculate the number of shares to buy so that if it hits the stop loss, you will lose 1% of your capital. Or if you're more aggressive, risk 2% of your capital. 1% conservative, 2% more aggressive, yeah? And you have to know where to put your profit target. So your profit target, when you hit the profit target, you should get double your initial risk. So in trading, you always want to ensure you risk $1 to make more than $1. You can risk $1 to make $1.50, $1.80, $2, $3, but always have that good risk to reward ratio, okay? So once you set up the trade, then you want to ensure that your chance of going up is higher than your chance of going down. Now, of course, if you just enter the market randomly, today you say, okay, let's toss a coin, let's buy, go up, right? Or toss a coin, it's going to go down. If you enter randomly, that is 50-50, right? So we're not going to enter randomly. We're only going to enter a long trade when the odds are in our favor, that the price has a higher probability of going up. So how can we get the odds in our favor? Again, we use technical analysis. So technical analysis is reading the emotions of the market and to trade with the emotional pattern of the market. So these are all the ingredients. These are all the ingredients that help us to build a high probability trade. Now, someone's asking about value momentum investing. No, this webinar today is on trading, not investing. For investing, watch my first webinar. You can watch the replay on the blackmarket.piranhaprofits.com page, right? So go watch that one later, right? But now learn about trading, okay? All right. So what are the ingredients? The first ingredient number one, is to look for stocks that are in a strong trend. Either a strong uptrend or a strong downtrend. So when a stock is on a strong uptrend, then there's a high probability the price will go up. That's right. It's like a river current. Look for a river with a strong current. If the stock price is on a strong downtrend, then the probability is the price will go down. Okay. So first thing is to identify stocks with strong trends. So example, ta-da! This is an example of a stock in a strong uptrend. Okay, this is a strong uptrend. So how do you know it's a strong uptrend? So one method I use is I use moving averages to identify the trend. So you see these colorful lines? These are moving averages. So the first moving average, the red dotted line, that's the 20 exponential moving average, the 20 EMA. The blue dotted line is the 40 exponential moving average, right? So the 20, that's a 40. This thick blue line is the 50 simple moving average. And the green line is the 150 simple moving average. Now, here's something very simple to understand. When the 20 is above the 40, that means the short-term trend is up. And when the 50 is above the 150, it means the medium-term trend is up. So I only want to take a trade when the short-term trend is up and the medium-term trend is up. So in other words, I want to make sure the 20 is above the 40 and the 50 is above the 150 in this sequence. So when you see this sequence 20, 40, 50, 150, it means that the stock is on a clear uptrend. Make sense? Simple? Okay. Now, do you think that all stocks are in a strong uptrend? Yes or no? No. In fact, I can tell you that at any point of time, probably only 5% of stocks are in a strong trend. The rest of the stocks are choppy. There's no clear trend. So for example, look at this one. Okay, so this is an example of a stock that is not in a clear trend. It's very choppy, right? You see the price is like, chopping up and down. It's like the airplane is going through turbulence, right? It's not flying smoothly, correct? So how do you know that it is not in a clear trend? Because the moving averages are not in sequence, right? It's not 20 above 40, 50 above 150. Look at the moving averages. They're all jumbled up. They're all crisscrossing each other. Can you see that? So when you see the moving averages crisscrossing, that means there's no trend. But when you see like that, oops, hold on. But when you see like that, the 20 above the 40, 50 above the 150, that tells you that it is a clear uptrend. You follow so far? All right. So rule number one, trade with the trend. If you trade stocks in a clear trend, it's a lot easier than trading stocks that are choppy. Very simple. Okay. So only trade stocks in a clear trend. Now, the next thing is using the moving averages. Now, again, moving averages, they don't just tell you the trend direction, but moving averages act as dynamic support levels. Okay, what does that mean? Now, notice that on an uptrend, the price moves in wave patterns. I've repeated this many times in my previous webinars. Can you see the wave pattern? Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So it's always this wave pattern. Now, notice that every time the price waves down, it would find support at the moving average. Can you see that? It hits the moving average, bounces off. 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 So I only want to trade stocks where they respect their moving averages, right? They respect the moving average because it's very simple. Because every time it hits the moving average, every time the price waves down, hits the moving average, that's when I want to buy to get in to catch the wave up. Make sense? Whereas for these kind of stocks that are very choppy, notice what happens. They don't respect the moving averages. The moving averages are cut very easily. So avoid these type of stocks in trend trading. All right. Okay, so number one, we look for strong trends. Number two, ensure the price respects the moving average. The moving average acts as a support level. Number three, I want to also ensure that when I enter the price, it is also hitting a strong support or resistance level. If I'm going long, it's a support level, right? Or it's hitting a Fibonacci level. If you want to know more about Fibonacci, you can go to YouTube, type Adam Khoo Fibonacci. I have created videos on teaching Fibonacci as well, all right? But let me give you an example right here. Okay, there we go. So look at this stock. So question one, is this in a strong uptrend? Yes or no? Is this on a strong uptrend? Yes or no? Yes. Why? Why? Because the 20 is above the 40, the 50 is above the 150. So the moving averages are in sequence. So when they're in sequence, that means the trend is strong. Number two, are the moving averages respected? Is it respecting the moving average? Yes. So you can see over here, the price goes down, hits the 50, the blue, and bounces off. And right here, it drops, hits the 50. Do you think it's going to likely bounce. Right? Again, wave down, hits the blue line, the 50. Do you think it's gonna likely bounce? Again, it's not a guarantee. We can't predict absolutely, but there's a high chance it will bounce. Why? Because this blue line has been a strong support that has been tested. Now, not only that, but also notice that this level here is also a horizontal support level. Why? Because take a look. Can you see this was a swing high, and another swing high. Together, they make a resistance. And later, after a breakout, it came back, and this resistance became a support. So this level is a very significant support and resistance level. So now that the price came down, not only is it hitting the moving average, it is hitting this horizontal support. So we've got a double support. We call this confluence. Confluence is when it is hit by double supports, moving average and a horizontal support. And these are the only trades I like to take because it's very high probability, right? Now, not good enough. We need another confirmation that is going to bounce up. So I also look at technical indicators. For example, you can look at MACD, you can look at RSI, Bollinger Bands, stochastics, Williams percentage R. There's so many indicators, right? And people ask me, Adam, which is the best indicator? There's no best indicator. It's like when you want to cook a meal, there are many spices: pepper, salt, olive oil, sesame oil, right? Which is the best? There's no best. Depends on the dish you want to cook, right? So for me, when I'm doing a trend following, I like to use indicators like stochastics or the Williams percentage R. So this is what it looks like. Ready, go, boom. So this is the same exact stock. Again, you can see wave down, hits the moving average, and hits the horizontal support. Plus, if you look at the Williams percentage R, you can see it is oversold. Now, the Williams percentage R is the same as the stochastics. It works the same way. It's also similar to RSI, that when it's oversold, what happens? It's like a rubber band. You pull the rubber band, it's going to snap back. It's going to snap back. So notice every time it is oversold, what happens? It will snap back. Oversold, snap back. So notice that we are building a case. Before you enter a trade, all the stars must be aligned. Correct? So we have got uptrend, we have got moving average support, we have got horizontal support, and now we have got oversold indicator. Not good enough. We need another one. It's like building a case in a courtroom, right? We need a lot of evidence is going to go up, right? And the next one that I use and I look at would be the candlestick pattern. That ideally when I enter, I want to see a bullish candlestick pattern, like a bullish pin bar or bullish engulfing pattern. And in this case, you can see, what is this, guys? I know it's a bit small. Let me see if I can make it bigger for you. Let me just expand this chart. There. Okay. Who can tell me what candlestick pattern is this called? What pattern is this called? That's right. It's a bullish engulfing, right? So now we've got a bullish engulfing on top of that. So we've got all the stars aligned. Do you think it's going to go up? Is it going to go up? Yes or no? You don't know. You can't guarantee. You can't predict the future. But it's just a good probability. Okay? Now, last thing is you also want to ensure that you trade the stock with good earnings. That right? So if the stock has strong earnings growth, sales growth, that's even more powerful. So I teach my students, ensure all the stars are aligned. And you take these trades. They don't happen very often, but when you take them, you get very high probability, right? So when we exploit repeatable patterns in collective human psychology, it gives us high probability outcomes that gives us a statistical edge in the markets. So what I showed you just now are all the ingredients, right? Moving average, Fibonacci, indicator, candlestick, but these are ingredients. Now, you need to know how to use all the ingredients in the right quantity and create a proven recipe, a strategy, right? So when you take my stock trading course, you can order the stock trading course online on the piranhaprofits.com website. We're having a great promotion right now. And in the stock trading course, you will learn all my proven recipes, all my proven strategies that use all the different ingredients for different situations, right? So for example, these are some of my more common recipes. You've got my trend retracement strategy that you're going to learn in the course, okay? The breakout system, the momentum value rotation system, the slingshot trading system, the capitulation. So there's many strategies that you're going to learn in the stock trading course. Now, let me say, why do I need so many strategies? Why? Because they all work under different market conditions. So, for example, the first one is called the trend retracement strategy. This strategy is used when the stock is on a clear trend, which is what I showed you just now, right? So like that, right? Wave up, wave down, wave up, wave down, wave up, wave down. So when it waves down to a support level, okay, which is a support level here, like a moving average or Fibonacci level, then we buy here. When we see a bullish candlestick pattern, get in, ride the wave up and take profit there. That's called the trend retracement. Okay. Now, the breakout system is different. This one is used when the price is in a consolidation and we enter as it breaks out of the consolidation. So in other words, for this one, the price is going like that. The price is going sideways, like coiling a spring, right? Coiling a spring. So it's going sideways, sideways, right? And then we wait for the price to break out of the consolidation. That's when we buy to ride the new trend up. Okay, so that's called the breakout system. And it's got different rules from the trend retracement, right? Now, remember I told you earlier that there are certain stocks that are very choppy. It's like, choppy, right? Yeah. Now, could you trade these choppy stocks? Yes, you can. Yes, you can using the slingshot system. So the slingshot, right, we identify when it's going to shoot up from a strong oversold level. Okay, now, let me show you some of these strategies. Would you guys like to learn more about some of these strategies? Okay, great. By the way, we've got like 2,800 people in the room right now. It's growing. Okay. So let me show you the trend retracement strategy. So what are the entry rules? Entry rule number one, you only do this on a stock with a clear uptrend. So question, look at this stock over here. Do we have a clear uptrend on this guy? Yes, right? You can see over here, 20 above 40, 50 above 150. All right, so that passed, right? Next, did the price retrace and test the moving average? Right? So wave up, wave down, and it's hitting the orange moving average. It's the 100 moving average, and this was tested before here, right? You can see it has been tested here. So this is a tested moving average. Yes. Next, when it waved down to the moving average, did the indicator become oversold? Did the indicator become oversold? Yes. That can you see here? Oversold. Can you see oversold? Right? So notice is oversold, you'll bounce. Right? You see oversold here, bounce. The rubber band, snap. Okay. Next, do we have a bullish candlestick pattern? Do we have a bullish candlestick pattern here? Again, this is a bullish engulfing pattern. So all the stars are aligned. Right? So once we know that, okay, all the stars are aligned, there's a high chance it's going to bounce up, then we place our entry order. So you can see here, I put my entry order 1 to 10 cents above the candle pattern. So now it depends on the stock price. So like this stock price is $300. So I'll use probably 10 cent or 20 cent. So I'll place my buy order about 10 cent above the high of this bullish candle. Why? Why do I put the buy order above the high? Why? So that the next day, if the price goes up, it would trigger the order and I'm in the trade. But the next day, if the price doesn't go up, if the price goes down, it will not trigger my order. That's why it's important that you place the buy order above the high of the candle. So we use a buy stop order, a buy stop limit order, right? Now, so this is the entry rule of getting in, but you always need to have exit rule of how to get out. People always think how to get in, they don't think how to get out, right? So after you enter, there are only two scenarios. Either the price goes up, or after you enter, it goes down. It could still go down, right? So what's the exit rule? So the exit rule is that I would put a stop loss 1 to 10 cents below the swing low, which is here. So I'll put a stop loss somewhere here. So if it goes down, I will cut loss over there. And I will lose 1 R, okay, or 1% of my money, right? But if it goes up, then I'll have a profit target up there. So I take profit at 2R or get 2% of my money or double the risk, right? So let me show you in more detail right now. By the way, this stock I'm talking about is ULTA, ULTA, and I took this trade about 2 weeks ago, right? And in fact, when I took the trade, I posted it on my Telegram chat group for my students, right? So the great thing is that we have got this Telegram chat group community, and it's not just me that posts trades. All the students are encouraged to post trades every day. So whoever sees a good trade, they post a trade, and then we share trades, and they get feedback on other from other members and myself. Like I say, okay, yeah, this trade meets the rules, doesn't meet the rules, and all that, right? So you can see this was posted here, and when I post a trade, I explain, right? Just spotted the altar for trend retracement setup, finding support at the 100 moving average with additional horizontal support. Williams are oversold at the recent swing low, plus a bullish engulfing candlestick pattern, blah, 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 right? All right. You can only join my private Telegram group only when you have taken the course, right? So you must take the stock trading course or the options course, the full course, and then you get into our private Telegram group, because we can only let you in. We can only let you in when you have learned all the lessons. When you understand all the lessons, then you can get in and discuss intelligently. If you don't learn the lessons and you go in like, don't know what you're talking about, right? And like this Angelica who took the trade says, thanks, Adam. I made 1,000 on Alta on this trade. Okay. So let me show you again the details of this trade. So again, this is the same trade, but I have made it bigger. So again, the first thing is my buy order. So in this example, I put my buy order at 373.8, which is 10 cents above the high of the bullish candle. I then put my stop loss 10 cents below this swing low pattern, which is 354.8. So I'm buying at 373. My stop loss is at 354. What is my risk per share? What's my risk per share, guys? What's my risk per share? $19. That means every one share I buy, I'm risking $19 if it hits the stop loss. Agree? So we call that the 1 hour distance. R represents risk. Now, if I'm risking 1 hour, how much do I want to make? How much do I want to make? I want to make 2 hours, for example, right? So 1 hour is $19. What is 2 hours? 2 hours is $38. So I put my profit target $38 above my entry. So 373.8 plus 38 gives me a profit target of 411.8. So that's how you set up your trade. Now, the most important thing next is position sizing, which is calculating how many shares to trade. So how? So let me show you the process. So how do you size your position? Now, so let's say, for example, your capital is $10,000 right now. This is called your net liquidation value. And before you start trading, you must decide on your risk per trade. So in this example, you decide to risk 2% of your capital per trade. Now, let me say something. Your risk per trade has to be consistent. So if you decide on 2%, you must always use 2%. If you decide 1%, you must always use 1%. You cannot change from trade to trade. You can't say, okay, this trade, I'm more confident, I'm going to risk 3%. This trade, I'm going to risk 1%. No, you can't do that. You know why? Because you never know which one will be a winning trade, which one will be a losing trade. You don't know. It's random. So you got to be consistent, okay? All right, so let's say you choose 2% risk per trade. Now, what's 2% times $10,000? What's 2% times 10,000? Guys, tell me. 2% times 10,000, what's that? $200. Very good. So in other words, the maximum loss you should get is $200. Okay, I repeat, the maximum loss per trade is $200. Okay, now listen carefully. If your total loss is 200 and each share you're risking $19, how many shares can you buy? You take $200 total risk, divide by $19 risk per share, you get 10.5 shares. Now you can't buy 10.5 shares, so let's round it down to 10 shares, right? So now you know you buy 10 shares. Simple, okay? Now, so if you buy 10 shares and each share is 373, that's $3,738 for this trade. Okay, so this is your position size. Now, let me ask you a question. Is this your risk? Is 3,700 your risk? No. What's your risk? Your risk is $200. So your position is not your risk. Remember that your position size is not your risk. Your risk depends on where you put the stop loss. Got it? Okay. So, question. If this turns out to be a losing trade, okay, if it happens to be a losing trade, how much do you lose? You lose $19, right? Times 10 shares. So what's $19 times 10 shares? You lose $190, which is close to 200, right? Because we have to round down, yeah? If it's a winning trade, you win $38 times 10 shares, you win $380. You got that? So now what is $190? $190 out of 10,000 is about 2%. Well, it's 1.9%, right? But let's round it to 2%, something like that, right? So this represents 2% of your capital. But if it's a winning trade, you win 380 out of 10 grand. That represents 4% return on your capital. Do you see how this works now? You risk 2% of your capital to get 4% return, or 1% to get 2%. Okay, great. Okay, so next, you don't have to calculate all this yourself. So when you take the stock trading course, you'll be given all the software that we use. And one of the software is called the position sizing calculator that calculates everything for you. So let me show you how this works. So this is the calculator. Let me open it up. Okay, there we are. This is the calculator here. So what you got to do is to put in your capital now. So let's say your capital is 10,000. Okay, and you're risking 2%. Okay, and you key in your entry price. So what was our entry price again? What was our entry price? From the slide, entry price was 373.8, right? Correct. And our stop loss 354.8, 354.8, and our profit target 411.8. Right. So you can see once you key in all these numbers, immediately it'll tell you, hey, you buy 10 shares, 10.5. Ta-da! So it makes it very simple. All right. So every time before you take a trade, use the position sizing calculator, put it in, and you're done. Right. And you know that you are risking 2% of your money to get 4% of your money back. Right. And of course, all the software comes with the stock trading course. Yeah. Okay. Now, so what I'm showing you now is how to trade stocks, how to trade the stock itself. But question, what are the limitations of trading the stock itself? What limitations are there? Well, the first limitation is you need more capital, right? Because again, in the previous example, we had to buy $3,700 worth of shares to make $380, correct? So we had to come up with a lot of capital in order to make that $380, right? So that's the problem with trading stocks. You need more capital, okay? The other limitation is that there's a risk of gapping below the stop loss. Now, how many of you have experienced this? How many of you have experienced you put a stop loss, but the damn price gap the next day or a few days later, the price gap down below the stop loss because of bad earnings or some event, and you ended up losing more than what you wanted to lose? Who has experienced that before? Right? So that is the risk of trading stocks. The stop loss is not guaranteed to help you. If it gaps below, you're screwed. Okay? The second limitation of trading stocks is that you can get easily whipsawed by manipulators. What does it mean by whipsawed? Again, who's experienced this? You buy there, you put a stop loss there, and right after you buy, the market makers, the manipulators, the algos, they drive the price down really quickly, hit your stop loss, you get stopped out, you sell that, and then it goes up to your profit target. You go, ah! It's like, someone came to your wedding and took your bride and ran off with the bride, and then you got stuck with the wedding bill. Who's experienced that before? Right? Done it, right? Yeah, so that's another limitation of trading stocks. But the main limitation of trading stocks is that to make money, the price must go up, right? The price must go up to make money. If the price doesn't go up, if the price goes sideways or goes up too little or goes down, you lose money, you lose money, you lose money. So in other words, you have to be right on the direction. And that's why nowadays I don't trade stocks directly. I use the stock trading course to identify the trade setup, but I execute all my trades with options. I execute all my trades with options. So instead of using the normal rifle or the M16 to shoot the enemy, once I've identified the enemy, I use more powerful weapons like the Uzi, like a shotgun, like a submachine gun, like a grenade launcher. So I make sure that the enemy gets killed more effectively, right? So how do I execute with options? Okay. Now, first of all, let me just tell you the main advantage of using options to trade is that you use a lot less capital. You use a lot less capital, and hence it increases your return on capital. Okay. Now, some of you may think, hey, Adam, are you saying that I should buy call options? If you go to Wall Street Bets and you notice a lot of these millennials, right? They trade by buying call options. I'm just curious, how many of you have done this before? You bought call options because you thought it's cheaper. And you thought with a call option, I've got unlimited reward and I have less capital, right? Okay. Now, one of the things that you must understand is this. As professional traders, we very, very, very rarely buy call options. In fact, let me tell you something. Buying call options is a losing game. It's a losing game. Once in a while, you can make a lot of money. Yes, you can. Luck. But most of the time, you're going to lose money, right? Because buying a call option is like a lottery ticket. You win once in a while, but all the rest of the time, you're going to lose. And whatever you make, you're going to lose everything to the market. Who's experienced this before? Who's experienced this before, right? Why? So why are buying call options not the right way to trade options? Because a few reasons. Number one, when you buy a call option, it is very expensive. And for you to make money, the stock price must go up enough to cover the cost of your option premium before you can make money, right? So in other words, to make money on call options, the price has to move enough, okay? If it moves a bit, you still lose money. It has to move a lot to cover the cost of the option. Number two, to make money, the price has to go up, right? If the price goes sideways or goes down, your calls will become worthless. And the problem is when you buy call options, they lose value every day because options are decaying assets. Every day it loses time value. So slowly and slowly, you're losing money every day until it expires, okay? So when you buy a call option, to make money, you must get three things right. Number one, you must be right on the direction. The price must go up. Number two, it must go up enough. And number three, it must go up in time before it expires. And this is very, very difficult. That's why it's a lottery ticket. Most of the time, you will lose money in the end. Okay. So what is the proper way to trade options with very high win rates? The way to do it, and the way I do it, and the way Bang does it, who's my options grandmaster, all right, is we use option strategies that are non-directional. Yes. So most of the time we use non-directional option strategies. What does that mean? That means to say we don't need the price to go up to make money. Even if the price doesn't go up, if the price goes sideways or the price goes down slightly, we still win. How? So I'm going to show you in a while. So take lots of notes and pay attention, right? Number two, I like to use option strategies that do not get exposed to time decay. That means every day that passes, I'm not losing value on my options. In fact, every day that passes, I want to be paid from the options. Okay, and I'll show you how that's done in a while, right? So by doing that, we are able to use options to increase our win rates significantly and to increase our consistent profits, right? So you may say, Adam, so what strategies do you use? Now, we have many, many strategies. So in the options trading course, we have got level 1 and level 2. We have got the Iron Shell, which is level 1, and Iron Striker, which is level 2, right? So in the options course, we teach over 18 strategies on options. And many of the strategies you can't learn anywhere else. You can't read it on any book. You can't get it on any website. You know why? Because they were invented by Bang Pham Van, who is my options grandmaster, and some of them were invented by me. So a lot of them are proprietary strategies that we created. Okay, not all of them, but some of them. Okay. So for example, these are some of the strategies that we use. All right. You have got the bull call spread. We have got credit spreads. We have got the protective bullish synthetic known as the Bubang. This was invented by my partner. We have got diagonal spreads. We've got calendar spreads. So these are all the different types of option strategies. Okay. Now, again, you may say, Adam, why so many different strategies? Okay. Because you use different strategies under different market conditions. Okay. So again, let me use an example. Let me give you an analogy, right? So when you learn stock trading, you learn how to find the trade setup. It's like you learn how to spot the enemy. You learn how to aim at the enemy, right? But what weapon do you use to execute the enemy? So if you just buy the stock, it's like you're using a pistol. Yes, you can kill the enemy, but it's not so powerful, right? But imagine, instead of a pistol, now you have a shotgun, right? So a credit spread is like a shotgun. You know how a shotgun works? A shotgun is like, boom, it sprays a lot of pellets. And the great thing about a shotgun is you don't need to be accurate. Because it sprays a lot of pellets, it will kill the enemy even if your aim is bad. Follow what I'm saying? So that's what I love about credit spreads. I'm going to show you an example in a while how we use a shotgun style where you don't need to be accurate and you still kill the enemy. You still get a winning trade. All right. Or you can use a bull call spread, which is like a pistol, but now with a silencer. So the enemy doesn't hear you coming. Or if the enemy gets shot, it won't alert other enemies to kill you. Right? Okay. And then one of the most popular strategies is called the Bubang. This is like using a freaking rocket launcher on the enemy to blow the bastard up really fast, right? And then we've got diagonal spreads and all that, right? So that's the analogy I give, right? So would you like to learn some of this and see how it works? If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.